Well, hello everyone. Don Garman here from Mirador Capital Partners. Here again, we are in the middle of February, February 15th. Happy belated Valentine's Day. Hopefully everyone got a chance to celebrate yesterday with somebody that they love. I thought I would reach out again, as we talked about a couple weeks ago. You know, as markets have certainly been choppy, we wanted to be out in front of you on a more frequent interval, you know, occasionally delivering uncomfortable news, but hopefully on a day like today, more comfortable, but always delivering news and certainly a little bit of perspective, at least on what we see as the backdrop, as challenging as it can sometimes be. Before I get into that, a couple announcements. Jonathan Ting, who's been with us for over 5 years, will be leaving us, and we, of course, all wish him nothing but the best in all of his future endeavors. He's getting ready to welcome the birth of his first child and is taking some much deserved time off as he prepares for that. And he's certainly a friend of the firm, and we are appreciative of all of his efforts on all of our behalf. And he will continue to be a friend of the firm for a long time. In addition to that, we're going to have a few other personnel changes that we will announce more about in the coming weeks, sort of taking an opportunity as we get, you know, hopefully out of the pandemic to reimagine the type of offering, services, and skills we need here at the firm, and be staffing the firm accordingly. None of the key players that you are all used to seeing now for many, many, many years will be changing, but of course we'll be shifting some seats around, and so more on that to come over the coming weeks. The third announcement is that for the better part of the last year, a little over a year, the team here at Mirador and myself have been working on a book, which we're calling the Mirador View, and it's simply a way to illustrate how our views on wealth management in the coming years have changed a little bit. Certainly our views on managing your investments or our investments and how best to do that, you know, potentially in an increasing interest rate environment, you know, would best be handled. And then, of course, we all know we have a particular attraction to the Tri-Valley from an investment perspective, both on the public equity side and on the venture side, and a little bit more about that for those of you who've wanted a little bit of a deeper dive. And so in the aftermath of releasing the book, which should be in the next couple of weeks, I'll be doing little videos kind of, you know, describing each chapter in detail. And so anybody who wants to consume a particular chapter in video form can kind of follow along in the weeks after. If you, you know, like the idea of video more than sitting down by the fireplace and reading a book or scrolling on your iPad and ebook. So anyway, more on that to come as well. So without further ado, getting into the capital markets. So we kind of were talking and followed the narrative of worst January by some measurements, depending on the market index ever. As we've gotten into February, there was some signs of stabilization. And then of course we have Russia moving into Ukraine in a, you know, in a very deliberate fashion, and the neighbor of Ukraine being Poland, which we are through NATO contractually obligated to defend, and teeing up this kind of, you know, geopolitical, you know, game of chicken where what level of involvement or how our, you know, or whether we would be involved is all being questioned. And obviously the prices that, you know, the other big story is the inflation that we're all seeing at the pumps and in our PG&E bill and at the grocery store and everywhere else is really starting to take its toll on, you know, whatever we're calling ordinary Americans, and really taking its toll on all of us, because I think we're all seeing the price increases. So because, you know, our style is not to lurch from one theme to another and change holdings, you know, lock, stock, and barrel into a whole new set of holdings, I wanted to just kind of talk about this period that you're going to be hearing me talk about a lot, this period from potentially 65 to 82, 1965 to 1982, where yields in general were rising and not falling. And that period, which many of you lived through, began to end, or the time that they refer to as the end of it, was when Paul Volcker, the current, the Jerome Powell of the day, set in mind to break the back of inflation by really raising interest rates to a high level to sort of pull down the levels of inflation, which teed up a 40-year period of declining interest rates that many of us believe ended, less than a year ago, and perhaps wouldn't be seen again for a long time. So the question is, if that is the setup, how do we respond to that? What is our response from an asset perspective to that? And I think that's the most important question that needs to be answered right now. So in that period, indexes did not perform very well. And my dad and I used to talk about it, and he would relay to me that, if you measure from a period in 65 to a period in 1982, the index was down 22% or so over that 17-year period. Now, if you can imagine a period where a 17-year period where the indexes were down, you'd say, oh, that's so far-fetched. However, the decade between 2000 and the end of 2009, that decade was also down. So we have lived in relatively recent history with extended periods of time where market indexes were not up. However, why you don't know that, or many of you don't know that, is because your investment accounts were not down over that period of time. Because of the way that we invest isn't necessarily only fixated on the index level. And we are very much more deliberate in the type of investments we make, and make investments at the company level. So even in long periods where indexes may not perform, if we're in the right basket of companies that are growing and innovating and changing pricing so that they have more earnings, so that they either, their earnings are growing or their dividends are growing, or both, in reality, that is going to be all of our best defense against an uncertain and unknowable future. If it's inflation, if it's high rates of inflation, or if it's deflation. That's the answer to all three of those. So where we spend the majority of our time isn't on the macro, guessing where inflation's going to go, or how many times the Fed's going to go, or any of those type of, or if we knew what Russia was going to do in Ukraine, what to do about it is not clear. So we don't spend a ton of time on those topics because we regard those as things we cannot know. And so therefore we spend most of our time understanding the mechanics of our individual portfolios and strategies, and making sure the strategies themselves perform as the type of, my old metaphor, car on a car lot. Minivans need to perform like minivans, and sports cars need to perform like sports cars. Whether or not that's the right car for you is absolutely up for debate continuously and is subject to change at any point. Some people who may have liked sports cars at one point in their life no longer favor those as their mode of transportation. So those are the conversations I think we will continue to have, and rightfully continue to have. But just know that even if we were clear that the backdrop for the market index over the next 10 years wasn't up, that doesn't infer anything about how I believe our own portfolios will do, because we're not bound. But make no mistake, many advisors and many styles are only bound to indexes, and only, because this has become the prevailing wisdom in our industry over a 40-year period of declining rates. So more about that in the coming weeks and months, and maybe perhaps years. Certainly there's a chapter or a segment of the second part of the book devoted only to that, and the research around why we think that's such an important period of time to understand. But we will leave it there for the day. We go into what I'm hoping is the end game of this pandemic, and we can finally look, and put it in the rearview mirror completely to a new day, and obviously new challenges ahead, but certainly challenges that we are aware of and are prepared to confront for all of our benefit on all of our behalf. So happy belated Valentine's Day. Thanks to you all. Please reach out. These videos are intended to be educational and to share with you some of the thinking if you have specific questions about your situation, please let us know. There's not always easy months, there's not always easy periods, but over time, looking back, we've made progress in nearly every environment. And so I think this time will be no different. So cheers, everybody. See you next time.